Good morning. This is Connor from 0DTE Traders here to present the week ahead for June 16th, 2025. Let's dive in. Wall Street faces a packed week as participants monitor rising tensions between Israel and Iran alongside key economic events and policy decisions. Given that geopolitical risks remain elevated, oil, gold, and volatility will be in focus this week. The Federal Reserve is set to announce its fourth interest rate decision of the year on Wednesday, while no change to the benchmark rate is expected at 99.8% probability. Markets will closely analyze the Fed's updated economic projections as well as Jerome Powell's press conference. On the economic front, May retail sales report will be released on Tuesday, followed by housing starts, building permits on Wednesday. On the earnings front, the calendar is relatively light with reports from Lennar, Kroger, and CarMax. The Gamma Index, which tracks dealer gamma exposure for the SPX, stands positive, 90 million notional, with price trading in close proximity to the 59.95 flip, indicating a neutral backdrop. All strikes above positive, that is supportive for the market price. Most strikes below negative, that is destabilizing for the market price. Below the flip of 59.95, we would anticipate elevated volatility with risk-off conditions emerging below 5900. Quarterly options expiration arrives this Friday with approximately 40% of S&P open interest set to roll off. This will be an influential factor this week. OPEX weeks often lead to pinning in, boxing around major balanced gamma strikes. 6,000 continues to be the big balance strike. We've seen a lot of mean reversion activity there, continues to be influential this week. 5,900 is the second largest gamma strike, a potential downside target in the event we do see a pullback here this week. Similar to last week, there's a mismatch between the call wall. 6,100 is the SPX call wall. For the SPY 600 today, although 605, 610 remain potential candidates. And we did see that call wall shift between the three last week. But given the mismatch here, still a big question mark on how much upside we're going to see beyond 6,000. Taking a look at the SPX 5-minute chart, well, first and foremost, equities are set to open higher. SPX with a 0.7% gap to the upside. VIX down 5%, now sub 20. So a bit of a positive tone to start the week. In terms of levels, just to give you a different visual here, we have the transition around that 6,000 handle. On the upside, first resistance 60.25, implied high 60.30. We have the downsloping structure, which could act as a resistance. There is a gap here on the upside, fill 60.45, followed by 60.50, 60.56, which is SPY 605 equivalent. And this is more or less the high from last week. So a break does imply weekly continuation to the upside with resistance at 60.75 and then that 6100 call wall. As far as the downside goes, below that transition, support shows at 59.75. We have another gap here from about 59.63 to 59.39, followed by some gamma levels in this zone, 59.50, 59.40, 59.25 below that. Implied low today, 59.21. That is a 0.9% implied move, followed by that big 5900 zone, 59.05, being that JP Morgan short call strike with expiration at the end of the month. Zooming out, taking a look at the SPY on the 4-hour chart, we did break some trend lines last week, most notably this large macro upsloping trend line connecting the April lows, as well as this rising wedge pattern. This is a bearish pattern with probable resolution to the downside. A break of last week's low, about 59. Or SPX 5963 would be a continuation indication. Although we're up here in the pre-market, we are finding resistance at that trend line. So is this going to be, a reject? We come back down to lows, or is this a break for potentially a move into the SPX call wall? Time will tell. We're 0DTE traders. We're not necessarily predicting this or positioning for a big move. We literally play day by day and trade our process. Lastly, turning to volatility, recall last week we highlighted that VIX was at the lower bound around 16 and that the risk was clearly to the left tail. Well, we did see vol catch a bid up 35% trough to peak, up about 22% off that lower bound. So volatility risk has turned more two-sided, potential exacerbating factor in both directions. Further vol contraction will invoke buy flow, support the upside. Further bid and volatility will invoke sell flows, exacerbate the downside. So vol likely to be a key driver of market moves this week. We want to be paying very close attention to those peaks and troughs and ideally trade in line with the volatility. Generally presents good momentum opportunities. Levels we're looking at here, 16.2, that is the lower bound. Not a whole lot of put open interest below. 17.4, 19.3, 22, 25.5, followed by 26.3. Now, if you want to take your 0DTE trading to the next level, learn from professionals, join the team at 0DTEtraders.com. Best of luck out there this week.